Hello, this is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. Today's video is going to be a summary of my November 10th energy update. In my October 27th energy update, I said we were likely in the early stages of a cyclical bull market, and based on the EIA's long-term production and demand estimates, we would experience a natural gas supply deficit in 2021, which will increase the risk of higher rates long-term. But as you can see, since my last report, NOAA is forecasting that we will experience milder than normal weather in the United States through November 23rd. And as you'd expect, milder than normal weather has resulted in natural gas prices pulling back from their recent highs. Upon looking at this chart, you may hesitate locking in rates now because they are higher than the fall low. But hopefully, after looking at the following chart of natural gas prices over the last 5 years, you will appreciate the wisdom of securing rates prior to the winter heating season. It is not uncommon for natural gas to experience small, mild weather pullbacks during cyclical bull markets. As you can see, the brief pullback in June 2016 was due to mild weather prior to the summer heating season. But as demand increased during the summer, prices increased and resumed the cyclical bull market that started earlier in 2016 and lasted 3 years. This year, we also experienced a small decline due to mild weather in November. But as demand increases this winter, prices will likely increase. As I said in my last report, no one can predict exactly where prices will be in the future, but the following risk factors could lead to higher pricing. Number one, year over year, we have 67% less active oil rigs and 45% less gas rigs. Therefore, the EIA is forecasting natural gas production will be much lower this winter and into 2021. Number two, in 2016, when active oil and gas rigs were this low, the average price of natural gas and electricity were higher the next 3 years. Number three, demand for natural gas is highest during the winter. Therefore, if we experience a colder than normal winter, prices would likely be much higher. And number four, we may have a new administration, and based on their past statements, they might support a ban on fracking during their administration, resulting in decreased production, leading to much higher pricing for natural gas and electricity. Number five, the uncertainty of PJM capacity auctions being delayed could result in higher supplier pricing, since suppliers will need to build in additional margin to cover their risk. These 5 risk factors are the reason why I recommend anyone who has not already secured a fixed natural gas or electricity rate to do so as soon as possible. As I previously stated, based on the EIA's long-term natural gas production and demand estimates, we are likely in the early stages of a cyclical bull market. And during cyclical bull markets, it is wise to take advantage of short-term pullbacks to lock in fixed rates. Therefore, I recommend taking advantage of the recent small, mild weather pullback and secure fixed natural gas and electricity rates prior to the winter heating season. My concern is the longer you delay, the more you may pay later. Hopefully this video helps you appreciate why it is in your best interest to secure fixed rates at this time. And until my next report, please take care.